Good morning, this is Ken Long from Tortoise Capital with a quick review of the rules for the index channeling system for our swing trade course. The first thing I want to do is start with a quick picture of what it looks like and to describe visually what we're looking for. Here's an example of channeling from 20 September 2012. We did this one at a workshop and framed it for the next day. So essentially what we're looking for is price greater than the 200-day moving average so that it's a bull market, and we're looking for an orderly pullback to oversold conditions on Williams percent R. And when we get that, we buy tomorrow's open mechanically. Now the choices for entry are buying today's close and absorbing tomorrow's risk, buying tomorrow's open, or waiting for a mechanical entry where price we hope opens in an orderly manner inside the real body, and then we enter when it takes out yesterday's high, or looking for an hourly breakout in the similar fashion as the triple screen. All of those are reasonable approximations of the system. The mechanical system that we brief with the stats is buying tomorrow's open because we think that's fair for someone that's not looking to hang around during the day to improve your entry, or who doesn't want to take the overnight risk, or who can't buy the close of business price or right at the close because you've got work. And so the reasonable mechanical entry is tomorrow morning's open, and so that's the primary entry for briefing purposes. It's a perfectly satisfactory way of trading the system. So again, all we need to see is bull market. It's better than this 200-day moving average. It has pulled back in an orderly fashion to oversold on Williams percent R10, meaning it's below -80. We simply buy tomorrow's open, and then we're waiting for it to resume its natural course, and the exit is when price gets above -30 on Williams percent R. It is now corrected, and then we sell the next day's close. This is a long-only system, cannot go short. You could elect to add the sideways area as an area not to take the trade. You might insist on price being better than 2% above the 200-day moving average rather than above the 200-day moving average. When we first built this, we just used the simplest market classification of all, and it trades satisfactorily in that. Good morning, this is Ken Long from Tortoise Capital with a summary overview of the index overreaction swing trade system. That's just the highlights of the rules and some of the concepts. So the mechanical application of this is for main indexes only. It only trades in the direction of the long-term trend. It can go short or long depending on that market condition. It requires a significant short-term move away from the primary trend, and we're going to define significant in a precise way to capture the idea that it overreacted against the trend and that the primary trend is going to pull price back towards it. And so we're going to establish a short-term trade to capture that snap back to the primary trend. To implement this system, we've got to define some concepts. We're going to use average true range percentage in order to define a significant move. We're going to call the 200-day moving average and price with respect to it the long-term trend. So if price is above the 200, the long-term trend is bullish. If it's below the 200-day moving average, we're going to call that bearish. And then we'll use the 10-day moving average as the short-term trend. And so we're going to look for a volatile move away from the short-term trend, and then we're going to play for a snapback or an overreaction move back to the short-term trend, which will quite often overcorrect, and so that gives us more than just the short-term fair value, which is represented by the 10. But might carry over and give us a little more reward. Now here's an example of a setup from September 20th, 2012. We have The price was well above the 200-day moving average. You can see here, this is the 10 and the 20. The 10 is this red line, and now the signal day occurs on this day when the high is less than the 10 and the close is more than 1 ATR percentage away from the 10 period moving average. So the magnitude of that move is what creates an opening here. Now what's nice to see is that this first long red candle is not a setup signal because it had some of its price on the proper side of the 10. So the fact that it straddled that 10 means this cannot be a setup date. This one may have signaled. It probably was pretty close. If you had gotten this signal, you would have bought here. And you would buy another one tomorrow because this one would this is where the signal actually occurs. But if this were a signal, this is where you'd buy your second position. So you can see already how agitated that market would be. You might think, well, this big red candle marks the limit of that up move. Historically, 70 to 80% of the time, this market corrects and goes back, and so you're buying in the direction of the long-term primary trend, and that's what that setup will always look like. You'll notice from the channeling video, this is also one that would fire on the channeling system. They quite often work together in that way. So that's what I want to say about the overreaction system. It's kind of a bread and butter system. It's in the market about 15% of the time. Unlike channeling, it allows you to go in both directions. And like channeling, very simple, can be mechanically applied, and there are ways in which you can optimize the entries on day one, on the day that you're taking your entries for the system. It's been a very reliable system for us for years. And that's the channeling, the overreaction system. Good morning, this is Ken Long at Tortoise Capital with an executive summary review of the washout swing trade pattern. This is one of my favorite patterns because it really illustrates the power and the importance of beliefs. And so let's begin with the notion, what if everything you knew was wrong? And so this thought occurred to me in the back of one of the Van Tharp Institute workshops where I was taking some notes in the back. And I was listening to Van talk about the power of beliefs, and I said, well, let me just try a thought experiment. Let me list everything that I think I believe in if I were to listen to the media or conventional wisdom. And then let me take the exact opposite of that belief in order to test Harry Truman's idea that it's not what you don't know, it's what you know that ain't so that gets you in trouble. And so I made a quick listing of beliefs, and I said under conventional wisdom that you should stay with the trend, ride the trend. You should look for the strongest stocks in the strongest sectors, that you can't pick bottoms, so don't even try. You should buy them when people hate them. You should have the courage of your convictions, and you should respect the idea that small caps outperform. That's why they have that little risk premium. So I decided then to write the polar opposite of that and say, all right, what if I had a strategy that tried to avoid the trend and look for the weakest stocks in the weakest sectors, and I tried to pick bottoms? And then the opposite of hate is not love, but indifference. And I said, well, what if we buy them when no one else cares? And what if I'm always afraid of these beliefs and I don't trust this system at all, and I'm very nervous to get out? And what if I focus on large caps instead? What would this kind of a system look like? I put an affirmation on it, an affirmation, and asserted that, well then, what I should be trying to do would be to buy weak large cap stocks in weak sectors when nobody cares about them anymore, when everyone who is going to sell has sold, when there is price evidence of short-term improvement. I should buy them when the market is going up, and I should even buy them if they're going up like that and the market itself is going down. I should plan for the most recent swing high as a reward to risk ratio of 2 to 1. Nothing in my belief system allows me to suspend the importance of that. reward to risk opportunity belief. And so I included those two lines. And then I would cut and run at the first sign of hesitation. I would not have the courage of my convictions. I would be quick to exit. And I would look for signs of institutional interest, because I'm talking about large caps here that have been beaten down. And institutions are not trying to get the absolute best price, but they're trying to buy recovering symbols when they have undergone some repair at a moment of value, when they are sold off more than is warranted by the fundamentals. And so watching for signs of institutional interest is what would help me believe that others, and not just me, were starting to see the value in these symbols. So that's the set of beliefs that I want to use. Now, let me operationalize these beliefs, by which I mean let me put them into something that I can code or pseudocode and define with some precision. So I want to buy the large caps, so that would be the OEX or S&P 100 symbols and large cap ETFs, very liquid ETFs. And that's where I get the institutional money potential and a certain amount of risk management, in that I don't think they'll go to zero overnight. Not that they won't go to zero, go out of business, but on a swing trade basis, I have some belief that they could last long enough for me to get out at a price better than zero. Now, to buy them when long-term sellers have sold, what I'm going to use is Williams percent R260. That's a year's worth of data. And it has to be less than minus 80, meaning that it's extremely oversold on an annual basis. And then I want them to be oversold on a short-term basis. So Williams percent R10, a 10-day look back, is also less than minus 80. And so now I've got targets that have institutional interest in them, with a built-in risk management in the fact that they're so large, that long-term sellers and short-term sellers may have sold. And so when we look at the Williams percent R, it would look like this, that we're deep into the oversold conditions. And now I want to look at price patterns for the setup day and then the entry day, because I'm going to be the second mouse on this one. And when I say second mouse, let me pause for a moment and talk ups from a week of swing signals for the 5DD. Here's one in Intel, and you can see this is day 5, day 4, day 3, day 2, day 1. So you've got the 5 days down in a row. And what I typically use for target for computing reward to risk ratio is the 10-day high. And so I would just plot a return to 26.9, and my entry would be 25.6, and I'd be using about a 60-cent stop or 5 cents below. Here's another orderly decay in Alcoa from a high of about $10. So there's 1, 2, 3, 4, 5. And notice you can have white candles in here, but what matters is that the close was lower. This is one in which you would also notice that the a channeling signal, if you're using it on the Dow components. At the time, this was in the Dow, as in 2016 it's not. So you actually have a channeling signal in here as well. Here's one in the S&P 500, where you can see the 5 days down. Robert Gardner would call that the red Niagara. You also notice a channeling signal in play here as well. So again, it only has to have 5 days down in a row to give us that signal. So that's what the signal looks like, and robust system, and one of my favorites. So the triple screen concept, the structured approach then, long-term trend, ADX greater than 25, or a MACD histogram uptick, the pull back to the 20-day moving average, or minus 80 on Williams percent R. A breakout to higher highs on an hourly candles. I now require a minimum 2-to-1 reward to risk ratio. so that if I just get a retest of the previous swing high, I'm still on the favorable side of value. I like to ratchet the trailing stop to break even as soon as possible. I like to use the low of the entry day or the previous day's low, whichever is lower is my initial risk. And if I get a 3R winner, I am looking to preserve 70% of the profits, or a little over 2. And then I may make or otherwise I will make a discretionary exit using candlestick patterns or other exit techniques. I like to lock them in, especially as we get more volatile and choppier and closer to the 200-day moving average. I just find that's favorable. Hi, this is Ken Long from Tortoise Capital with a review of the 551W swing trade system. This is an executive summary, and you should consult the system's definition for the details. And so the 551W really illustrates the notion of where do ideas come from. And there is a mastermind effect here. At a workshop I was holding on swing trading, on the morning break of day 2, Leo Willert, my friend from Austria, and I were talking about drumming, and he came up to me and said, this is the third time he'd been to that workshop, and he said, you know, Ken, I know you like things that are up 5 weeks in a row, because at that time that's one of our ETF weekly switching systems required that as a rule. And I know you like 5 days down because we just got done talking about the 5DD system. And I know you like 1 day up as the and buying the second day of momentum. So I know you like that. He said, what would happen if there were a system in there? Do you think there might be one? And so, and immediately into my head, I thought of well, yes, this is the 551 system. 5 weeks up, but it's down for 5 days, and then yesterday was up, and that looks like a system that I can enter with a universal entry, 5 cents above yesterday's high, the stop 5 cents below yesterday's low. And in my mind, to get reward to risk added in there, I said, let's put a Williams percent R less than minus 50 so that we have more of the trade ahead of us than behind us on a retest of the 5-day high. And so, and then instead of just a 5-day, let's make it a 10-day high. So we were using, as a provisional rule, Williams percent R less than 50 on a percent R for a 10-day look-back period. And I was trading it that afternoon because I was so comfortable and confident about the integration of those rules that I felt like what we had here was a way to get into positions that were generally in an uptrend over the last 5 weeks, had a measurable pullback and already demonstrated 1 day of momentum held overnight, and then we're buying the second day continuation, and there was enough room reasonably ahead of us to participate in that move. And so the 551W was born. And so we quickly wrote the following rule set for this is a stock chart pseudocode here. We said let's consider initially the ETF 100 plus the S&P 500 stocks, and let's make sure that the simple moving average of volume is greater than a million shares, so we have something that's large and liquid, and we want it at a price that's greater than 10, so that narrows us into symbols that institutional money has to move around. And then we want a close today. Today is a setup day. If the close is greater than the weekly close 5 weeks ago, so it's up for 5 weeks. And then today's close is less than the daily close of 5 days ago. And you'll notice this is a more relaxed criteria than the 5DD, which demands 5 lower closes in a row. This one simply has to be down compared to where it closed 5 days ago. And the intermediate prices are not as important or important at all. And then we said today's close had to be better than the close yesterday, so it was an up day. And we want today's open to be better than, to be less than today's close, so it's a white candle. So it's a white candle that closed higher than yesterday's close, and that's going to be how we define our 1 day up. And then the percent R for today, percent R look back period 10 is less than minus 50. If you want to hold out strictly for a 2-to-1, you can, and you would just make that less than minus 67, and that would give you a 2-to-1. But we felt on this one that we were willing to accept slightly less than the 2-to-1 reward to risk ratio in order to get more signals, and that's turned out to be a reasonable approach.